Hello friends, welcome to my channel InfoCraze. Today we are going to discuss about the basics of balance sheet. As you know, balance sheet is one of the most important financial statement for any organization. So today we will get into the basics of balance sheet and then we'll understand that what all components are included in a balance sheet and what all needs to be understood by a student or a professional or an investor. However, before going into the depth of balance sheet, we will also quickly touch upon the financial statements that are required for any organization. So let's get started. To start with, we have three different types of financial statements for any company. Number one is the income statement. Number two is the balance sheet. And then we also have the cash flow statement. As many of you may know, these three statements are the most important financial statements that any company should prepare during a financial year. So what is income statement? Income statement shows the profitability of a company for a period, whereas the balance sheet shows the liabilities, assets, and shareholders' equity on a particular date. And the cash flow statement finally is the movement of cash during a period. It shows how the cash inflow and outflow have happened during a particular period. So thus, if you see, these three statements are very important for any company to monitor their financial records. Today we will discuss mainly about the balance sheet. However, if any of you is interested in also understanding income statement and cash flow statement separately, you may put that remarks in your comments. I will definitely get back with a different video for that. So now let's get into the depth of balance sheet. What is a balance sheet? Balance sheet is like a financial snapshot of a company on a specific date. It is often called the statement of financial position. We will first understand the components that are included in a balance sheet. We have the assets. We also show the liabilities and then the shareholders' equity. So these are the three important components which are shown in a balance sheet. What are assets? These are basically the resources owned by a company on a particular date. Liabilities means the money that a company owes to others on that particular date. And shareholders' equity is the money invested by shareholders in a company. So if you see, when we are talking about a balance sheet, we are always referring to a particular date. So mostly when you are looking into a balance sheet of a company, you will find that the balance sheet is prepared on the last day of the financial year. All the auditors or any other professionals normally review the balance sheet on the particular date. That is the last day of the financial year. Now we will discuss about assets of a company. Assets are normally of two types: current assets and the non-current assets. Current assets are the short-term assets like inventory, debtors, cash in bank. So all these assets are those assets which can be converted into cash faster, whereas the non-current assets are procured for a longer period of time, like long-term assets, like building, plant and machinery, intellectual property. If you see, these assets have a longer period of service, so these assets are called non-current assets. And the sum of these current assets and non-current assets are the total assets of a company. Hope you have understood about the assets. Now let us understand something about the liabilities. Like assets, liabilities also can be current and non-current. What are current liabilities? From the word itself, you can understand that these are the short-term obligations, like accounts payable to your Sunday creditors, short-term loans which you might have taken and you need to repay back at a faster pace, whereas the non-current liabilities are those which are long-term loans, long-term debts. So like some of these current liabilities and non-current liabilities are the total liabilities of a company. So we have understood assets, we have understood the liabilities. Now we will discuss about shareholders' equity. Shareholders' equity consists of retained earnings and share capital. What is retained earning? It is the net income after payment of taxes and dividends to shareholders. And the share capital is the funds raised in exchange of shares. Sum of these two is called the shareholders' equity. So hope you have understood assets, you have understood liabilities and the shareholders' equity. These are the three components which are shown in a balance sheet. Now we will discuss the final equation of a balance sheet. The first that comes is the assets, which is equal to the liabilities plus shareholders' equity. So you will see that the liabilities and the shareholder equity are shown in one side of the balance sheet and assets are shown in the other side of the balance sheet. And these two should match. It is more like a seesaw and it should balance. For some reason, if both the sides are not same, so that means there is some problem in the balance sheet and you need to find out the error. In other words, we can also show it like this: assets minus liabilities is equal to the equity of a company. Whereas this assets minus liabilities is also called the net worth of a company. So thus, when you prepare a balance sheet, you will have assets in one side, you have the liabilities and shareholders equity on the other side, and sum of all this will be the total liability and sum of all the assets will be the total assets. So this way both the sides should match. Hope you are getting a feel of the balance sheet, and if you have any other query which is more specific to any of these subjects, you can definitely put your comment so that I can revert back. So when we have understood the equation, let's get into the next slide. Whenever you have a balance sheet with you, you might be required to review the financial position of the company. So how do you do that? You can do that by referring to various ratios and the terms which help you to understand the financial strength of the company. First, we will understand about the current ratio. Current ratio is a ratio of current assets to current liabilities. What does it give? It gives you an idea of company's short-term liquidity. It also measures a company's ability to pay short-term obligations or those due within 1 year. Second, what we are going to understand is the debt to equity ratio. This is the ratio of debt to shareholders' equity. This ratio shows the proportion of debt used to finance a company's assets relative to the value of shareholders' equity. Third, what we are going to understand is the working capital. It is calculated as current assets minus current liabilities. Working capital indicates a company's ability to cover its short-term obligations. It helps to plan for future needs and ensure the company has enough cash and cash equivalents to meet the short-term obligations. So these three key terms are very important and needs to be reviewed whenever you have the balance sheet with you, so that you can understand that whether the company is worth investing, or maybe you are a finance student, you might have different questions based on these three ratios. With this, we come to the end of this presentation. If you have any doubt, you can definitely put your comments so that I can prepare more details for you. Thanks for watching the video. You may please put your queries in the comment section. Thank you very much.